Hi there, welcome back to our channel where we bring you the latest and the most important news affecting the global economy and beyond. Today, we have a significant update from the financial world and that you don't want to miss. So if you haven't already grabbed your favorite snack, settle in, hit that subscribe button, and don't forget to comment below the video with your thought and opinion. In July 2023, the Federal Reserve Board made a move that had far-reaching implications for the economy and your financial well-being. They raised their benchmark interest rate by 25 basis points from 5.25 to 5.5%, making the highest level in over 2 decades. Last month, the Fed decided not to make another rate hike, and for the next week, the jury is still out. But we hope that it will not raise any interest. These decisions are part of the Federal Reserve's ongoing effort to combat inflation, which has been a persistent concern in recent times. What does it mean for you, our viewers, right now here in America? How will it impact your everyday life and your financial decisions? Stick with us as we break down the key point and dive into some of the details. Leading the meeting was the Federal Reserve Chairman, Jerome Powell, who has emphasized the importance of reducing inflation without causing significant economic disruption. The objective here is to try to achieve a soft landing. He mentioned that a rate hike might be possible at the September review. But again, the soft landing for the economy is really the goal. Let's delve another aspect of this financial landscape that is just as pressing. Believe it or not, Janet Yellen is going to sell even more treasury bonds. The borrowing is far from over and the situation is not great. Initially, I have to admit that I thought that the treasury would sell only on the front end to get short-term debt. But folks, this is getting much worse. Now Yellen is selling long-term bonds. Initially, it was a lot of 10 days and 3 months treasury. Now it is even some 10 years treasury. We are borrowing at a higher yield. What is the US doing? Well, we can say that they are kicking the debt football down the field. Congress kept spending and the government keep issuing debt. We are borrowing at a higher yield. The US Treasury offered $100 billion to pay back 84 billion US debt on August 15, 2023. This is crazy, folks. Yellen is not only adding more debt, but is also issuing more than 16 billion at a higher interest rate. If you look at the debt serving cost, it is now at the highest level since 2009. US interest rate on all US debt is surging, approaching 3%. This will keep increasing unless US interest rate on all US debt is surging, approaching 3%. This will keep increasing unless Jerome Powell decreases interest rate. And look at what this administration is doing. They are raising the debt by $1.2 trillion in just 1 month. You see that the US has now been downgraded by Fitch to AA+. So this is, ladies and gentlemen, not sustainable. There will be a point when this will be imploding, where the platinum credit card of the US economy will expire. We cannot continue to raise debt just to pay the interest on the debt. According to the Peterson Foundation, which I've been following for a year, by 2023, for every $1 of federal revenue, we will have to use approximately 40 cents on the dollar just to cover the national debt. The rationale behind this may be that Janet Yellen believes that interest is going to continue to rise. In her mind, long-term bonds are the less of two evils because the reverse yield curve, the cost of the short-term debt, is much higher than the 10-year treasury. So if we continue to experience an environment with high interest rates, Yellen's strategy would be right. But if the economy falters and the Fed is forced to decrease rate, then Yellen is basically wrong. So folks, we're basically kicking the can down the road in a very dangerous way. And I personally believe that we are rapidly approaching a period of deep recession. In addition, the more Yellen is borrowing, the more the inflation problem will last. And of course, the longer we have high inflation, the longer the Fed will have to keep high interest rates. It becomes a self-fulfilling prophecy. The nightmare will not stop. In August, the Treasury sold 167 billion in long-term debt bonds. If interest rates continue to rise, it also caused the interest of mortgage bonds to rise, so corporate bonds will have to rise as well, and it is almost at 5%. This will put more pressure on corporate debt and growth will be stalled and be directly affected. US companies have issued a tsunami of corporate debt, $400 billion, and now it is close to $420 billion. The trucking company Yellow has laid off 30,000 employees and filed for bankruptcy because of their corporate bonds that they could not pay back. Yellen is going to make things worse. In the last quarter of 2025, more than 1.4 trillion of debt will have to be refinanced for the multifamily industry. This is going to create a massive issue for commercial real estate, as many syndicators will not be able to refinance their debt, with lower valuation of the portfolio banks, and more importantly, with banks not being willing to provide loans at 85 or 75%. The loan to value may be at a much lower percentage. We expect that loan to value will decrease around 60 to 65%. The financial market are closely watching this development, and experts have noted that the Fed statement had an hawkish bias. Chair Powell post-meeting comments were somewhat dovish, suggesting that the central bank is not firmly committed to further action beyond the months of August. So we will see coming very soon what happens by mid-September. The US economy has been growing at a moderate pace, around 2%, and the job market has shown robust gains in recent months, with low unemployment. However, inflation remains elevated, which has prompted the Fed to continue its tightening campaign. The Conference Board Index fell to 106 in August, while the consumer 6-month outlook dropped to 80.2, the lowest in 7 months. It tells us that spending is going to fall, and retailers start seeing consumer pulling back. People are not feeling good about the US economy, and they are de facto spending less. This is the reason why the real estate market is collapsing, and we've seen several markets across the country dropping in prices by more than 20%. And this is to be expected. If you're trying to reduce demands by high interest rate, borrowers are less inclined to take mortgage at 7.5 or 8%. The cost of capital is just too high. So even though the market expects rate to be higher, we will need to see rate dropping from consumer to turn things around and continue to spend. And what is alarming is that we are seeing the early sign of a deep recession. Job opening are shifting. US job opening declined by more than forecast to 8.83 million from 9.7 million from 9.7 million in June. The Economist recently stated that a recession is coming. 3 important trading partners of the US are facing serious economic contraction. Something weird happened with the US economy. As it continued to grow over the past quarter, the US economy appears to be resilient. Customers continue to spend and consumption remains high because of government printing. In 2022, the federal government spent 6.27 trillion, which represent 25% of the GDP. What we are seeing is the US government support the US economy with massive spending. So we are facing a catch-22 situation where the Fed has raised interest rates 10 consecutive times to contain inflation, while the federal government is engineering a massive support of the economy through dramatic money printing. We are avoiding a recession through perpetual deficit creation. If you look at 2022, we had a 1.61 trillion deficit, and we continued to spend money like a drunken sailor. It is essential for Americans to stay informed about these monetary policy changes. While the rate hikes may impact borrowing costs and interest rates on loan, it is crucial to keep an eye on the broader economic trends and how they affect our day-to-day life. So be prudent and spend your cash wisely. This is not the time for frivolous spending. Do not over-leverage yourself with new credit card. This is the time for belt tightening. This is not the time to get a new credit. There you have it. Follow our latest news from the Fed and its effort to manage inflation. The implications are significant, and as Americans, understanding these changes is essential to make informed financial decisions. Before we sign off, we want to remind you to stay subscribed to our channel for more updates on the financial landscape and other news affecting our beloved country. And as always, we want to hear from you, our viewers. Drop your comment below and let's keep the conversation going. Until next time, stay informed and stay connected. Thank you.